Dustin Tibbits here, financial advisor with Jazz Wealth Managers, because that's what it says on the shirt. This will not be a long video. There is something really, really interesting happening, or that has happened in the market. And we follow this stuff because we're like the only advisors that actually follow market statistics, market performance, and studies and things like that. Because we build our own funds here. We do not use mutual funds and charge you for things like that. We focus on building our own funds, and they're expense-free. They cost you nothing for all of our clients. Hope you check us out at jazzwealth.com. Okay, I told you this wouldn't be a long video. For the month of April, the average daily change in the S&P was basically 2%. It was 1.99%, meaning on average, each trading day had a plus or minus range of 2%. Is that odd, right? You guys know that over the years, I've always said, well, if you give me a statistic or you tell me something, I'm going to go, is that odd? And then we're going to study it. Well, 2% is astronomically higher than what the market normally does. Did you know that the average daily change of the market since 1928, so the S&P started in 1928, September 1928 to today. We take all those years, right? Nearly 100 years of data. We go, well, what is the average daily change? Did you know it's 0.04? Okay. The average daily change for April was 2%. Now let's think about this for a second. Let's pretend that that's your blood alcohol content level. You get pulled over. 0.04 is acceptable, and you blow a 2.0, right? You're going to be national news at that point. If you didn't die, we get what's happening there. So anyways, let's take a look at some of the data. This is real quick here. So we look back and we said, well, let's look at every other month where we've had a large month of average daily changes. So for example, down here at the bottom, we have 2% for April. We don't know what's going to happen now. We had 2% during COVID, 2% or 5% during COVID. You could see a lot of the financial crisis days in there, the dot-com areas. And then of course, we all know, do you remember 87? Or do you go back that far? I don't go back that far. In fact, I was 5 years old, but I studied it. It was a fascinating event. Actually, if you want to see something really cool, there was one guy that stopped the market from going to zero. Literally one guy. It's a fascinating video. I think it's a documentary where he was like, well, if money means nothing, then I can bet whatever I want. He went over and saved the entire market. It was really cool. Anyway, so we look at all these other periods here and we go, okay, cool. When the average daily change is 2% or roughly 2% or greater, let's look 1 year forward and see the returns. We have many double-digit returns. In fact, during 2008, that is the only time where 1 year forward, we were not positive. Every other case we were. So my favorite number, 92% of the time had positive returns 1 year later. The biggest returns came after the biggest bottoms. What did we just have? Pretty severe bottom. Well, at least right now, we're marking it as a bottom. We don't know. It could fall back apart. But for now, we appear to have made a bottom. The biggest declines that we have produce the biggest moves, right? So all the other advisors will be like, pat you on the back and just stick with it, buddy. The markets go up and down or whatever. No, I want to be the advisor that goes, hey, okay, stick with it and everything, but the market doesn't do this. Get in there and get a piece of it because this doesn't normally happen. So I love sharing this data where we go, hey, the average return 1 year later, 22.55%. Okay. Highest return, well, it's over here, 53.71%, where we marked the bottom in COVID there, right? If you're looking through at some of these days here, March 2009, that's where that guy from CNBC, he's since passed away, but literally on TV with him and Erin Burnett, and I remember her name because I kind of had a crush on her. But like you have the two people sitting there. Intraday, he goes, that's the bottom. And it was so cool if you ever want to look up things like that. But anyways, the only negative return was 9.37% during the financial crisis there. So what does this tell you? When the market has these wild moves throughout the month, when the average daily move is very large, number one, it doesn't continue. It is not a long-living thing. Look at any one of those scenarios and you see, yeah, it was really wild, but then it just kind of stopped, right? We went back on our merry way, and we're starting to see that now in our market. The second thing it tells you is when the market has these wild daily moves on average, it tends to produce longer-term gains because these large average moves come on the way down, right? when people are panicking. They panic one day, oh my God, I messed up. And then they buy again and then wait, no, there's still bad news. And it does all this other stuff. It's crazy. So use the data to squash your emotion, right? I always joke I'm dead inside, right? Like, cause I'll use the data. I don't care what my emotions tell me. I have to operate. We now manage over $500 million for clients. I have to operate rationally, not emotionally. So we're going to use the data to do that. I hope you learned something here today. And if your advisor is not teaching you this stuff, come check us out, jazzwealth.com. You can schedule a call. We have zero sales pitch. Just talk, chat to Haley, Chris, whoever around here, and we'll set you in the right direction, even if that direction is not with us. All right. See you soon.